All right. Ladies and gentlemen, welcome to What Are Your Thoughts? An all-new edition. It's Tuesday night, 5 o'clock on the East Coast. That means Michael and I are live, interacting with the chat. Chat, say hello to Michael. He's going to pay attention. He's going to pay attention. He wants to see...
No, I'm not. You have my full attention. That's how I do it here.
All right. Joe Altamoro is here. Akbar Muhammad, what up? Ben is here. Jay Luther, John Carlo. Magnus is back. Chris is back. Georgie, we see you. The doctor is here. Guys, Nicole is in the chat tonight. Say hello to Nicole, everybody. All right, we got the whole gang is here. This is an incredible moment in market history. I have almost never seen anything like this in my entire life. And we have so much to talk about. But before we do, Michael, we have a sponsor tonight. Who's the sponsor of the show?
Guys, it's public, and I want you to do something. Leave the old, boring, legacy, outdated platforms that make it hard for you to invest. Public makes it really easy. What do you want? Crypto, stocks, good old-fashioned bonds. They got it.
Cash account.
Cash.
You do like a high interest cash account if you don't know what to invest in, or you want to sit out. You want to say, you know what, this is not for me. I'm going to earn a little bit of interest while I figure out what I think is going to happen or how much risk I want to take. That's always an option too. I'll tell you another thing. You also can get up to $10,000 if you transfer an existing brokerage account over to Public. So let's tell people where to go. Public.com/WAYT to learn more. Paid for by Public Investing. Full disclosures in podcast description. All right. Here's where I want to start. And I know you wanted to start here too. Josh was right. So we had you weren't debating me really. You weren't understanding what I was trying to say. We had this conversation.
So much.
No. I don't think you were on the other side of this from me.
Okay.
You just were wait, I don't understand. That's all. But we had a flare up on the show a couple of weeks ago. His Callie was on last week. So I think it was why, what is the market responding to? Why is the market rallying? Right? And I don't know. All I know is the market looks like they're now laughing at the tariff headlines. So my best guess at the time, and now it seems like it was the right guess. My best guess is the market no longer believes, circa early May, what it believed in early April, which was that tariffs were going to be here to stay. They were going to get worse. People just basically said, you know what? He's capitulating already. Carve out for semiconductors, carve out for phones. Now he's talking to the auto industry. Now he's telling the retailers, don't worry, and winking. So it was just the stock market each day was yeah, this tariff thing's not real. And that's where it ended up landing. And, nobody could really predict that in advance. But I feel like day by day, stocks started to just decide this is all going to be a big joke in the end. And that's what ended up happening. You had a capitulation over the weekend. So I just wanted to get your take on was that the right instinct? Why stocks are rallying? They definitely weren't rallying because we're going to get all this tariff revenue that's going to offset income tax.
Yeah. All right. Well, if you rewound during the throes of the sell-off, I was pretty vocal saying that I don't believe him. And I was saying at the time that I could end up being wrong, but I don't believe that he doesn't care about the stock market. I don't believe that he doesn't care about the scoreboard. He's a narcissist, and
that was the right call.
Yeah. So, okay. However, I am still surprised at the stock market's reaction. So, for example, I am surprised that over the last 24 sessions, according to Mike Sicardi, the S&P 500 is up 18.5%. That has only happened, a 24-session 18.5% rally has only happened in 1982 at the bottom, in 2009 at the bottom, and in 2020 at the bottom. This V-shaped recovery has me surprised. Bespoke tweeted, the last time the S&P 500 erased a 15% decline in under 6 weeks was 1982. This is rare. This is highly unusual. So I cannot believe that we've had a V-shaped recovery that took back all of the declines, because if you ask me, and if you ask the average investor, are things better today? What's going on in the chat?
Nothing. I think the whole stream is in unison, basically confirming what you're saying.
Okay.
If you go back and listen to what you were saying, you were actually saying in real time, no way.
Yeah, I was. But I'm still absolutely flabbergasted that the market hasn't said, you know what? All right, this is a confidence game, and we are not as confident in the multiple that we should be applying to our stocks, given all of this, and given that earnings are probably going to slow down. There's probably going to be some negative impact to the market. But the market is looking all the way past that, because they are temporary setbacks, is what the market is saying, I think.
I was super bearish in late March and right through the bottom of the market, and look, I bought stocks anyway just because that's what I do. But I absolutely did not think that we would retrace the entirety of the sell-off.
Nobody did.
And then be looking at a situation where you're now 5% or 4% from back to the highs.
We're up on the year. Like, what?
Yeah, 100%. In a million years, I never would have guessed it, which, look, I think speaks to why it's so hard to try to guess which direction the next 10% is going to be. I don't know anyone that can reliably do it. And I don't even know that even if you can do it, like even if you can say the next 10% is going to be this, and then it happens, well, then what do you do?
Right.
Then you have to make another guess. And then that leads to another guess. So I was super bearish throughout the month of April, still sort of bearish, not super bearish anymore because prices went up.
Yeah.
And I think that's how it lands on regular people. Like when things on the screen get better, you start thinking about, well, maybe it wasn't as bad as I thought. And then when it happens every single day for 3 weeks, it's like impossible to not consider the fact that stocks sniffed out the truth, which is the whole thing's a joke. And of course, Trump was going to capitulate. It was only a matter of whether or not he had somebody else do it for him. In this case, he sent Scott to Geneva and he said, do me a favor, don't come back here without something good. I can't, I don't want to hear it anymore, or whatever he said. And that's what he got. By the way, Peter Navarro was not sent to Switzerland. That was probably good for 7% of the S&P's rally. Lutnick was sent to a TV studio. Besant was sent to Geneva to meet the Chinese, and Peter Navarro was sent to his bedroom without supper. No, basic, right? Have you seen him?
No, thank
They
God.
basically said, hey, do yourself a favor, shut the fuck up. We're trying to get this thing back on track. And he's gone. Like that. You think that wasn't the conversation? Stop. You're off TV until we tell you. You ghoul. Nobody wants to hear your bullshit anymore. So, I think where we are now is like super insane. And I don't know if you threw money at all these stocks during the course of the market bottoming in April, what do you do now? You keep them all? I'm not selling anything. It keeps going up.
I haven't sold.
You bought a bunch of shit too.
I bought Nvidia, Uber, CrowdStrike.
Oh yeah, that's right. You bought CrowdStrike in the 300s.
Yeah, so I'm up like 30% on a lot of these names. I'm probably going to lighten up a little bit. Not because I have an opinion on the future of these stocks, but it's 30% in 2-3 weeks. You got to lighten up. So
I doubled my Amazon position. I added to Uber. What else did I do? I didn't buy Starbucks. That was the one I should have bought. Oh, I bought more Toast. We're going to talk about Uber and Toast later.
I think this is silver lining, just purely from
Netflix. I bought Netflix.
Good for you.
We did it on the air during the show. That I might sell some of that. That's up a lot, dude.
You have to remind yourself how you were feeling 4 weeks ago. We were all nervous. And let this be a lesson. Let this be a lesson for the next time something like this happens.
I still am nervous. I understand that now the trade uncertainty is gone.
What are you nervous about?
We're not gone, but significantly diminished.
What are you nervous about?
Well, 145% is not 30%. So, but 30% is still not great for the economy unless everything is an exception.
But
And then-
everything's going to be exempt. Everything that matters.
yeah. Great.
Here's what I'm a little bit nervous about. You would think that at some point, yields are going to matter and be somewhat of a headwind for stocks. The 10-year hit 4.5% today. In recent history, that has kept a lid on stocks.
You know what's funny? Compared to the shit that we were worried about like 3 weeks ago, that almost seems quaint.
No, I'm making up reasons to be worried. The VIX is under 20. The market's not worried. Why would you be worried?
Let's do some stuff here. Anyway, for those who aren't paying as close attention to this, basically Trump went from 145% tariff on China circa the first week of April, and that is now down to down to 30% and probably going even lower. It's like, and by the way, that's not like the new tariff level. That's the baseline level while they negotiate, and I think they gave themselves another 90 days. Right. So this is the New York Times. Let's do the next chart. So this shows that chart, and then below it is the tariffs imposed by China, which went from 10% on certain things like nat gas, coal, and farm machinery to 34% on April 4th, 84% on April 9th, 125% on April 11th, now 10% on May 12th. So China took almost all the tariffs off. So did we. Nobody made any concessions. This is the New York Times. President Trump made big promises with his China tariffs. China needs us more than we need it. America can outlast China in a trade war.
Oh, yeah?
Those advantages will let the administration get big concessions and rebalance global commerce. Trump's actions, however, suggest that talk was bluster. China made no concessions. By now, most of us are familiar with this pattern. Trump makes big claims about what his tariffs can get, only for him to later back down without the other country giving up anything meaningful. It happened with Mexico, Canada, and most of the Liberation Day levies. Despite his claims, America seems to need other countries' trade as much as they need ours. All right, so that's the New York Times weighing in on that. I wanted to ask you, because stocks rallied as furiously as they did, does that mean that the whole theory where, hey, we're going to get all this tax money from overseas, and that's going to be what pays for the extension of the tax cuts in the TCJ? So is this like proof that the market never believed in that story and never will?
I think so.
Yeah. Can you expound on that, or what do you think?
No, I don't know about I don't know enough about the tax code. Sorry, I don't have an opinion on everything. Okay, I don't know about this shit, so I punt.
One of the things, the responses from Howard Lutnick over the last 6 weeks is, of course, we have to do the tariffs because we're going to extend the tax cuts, and China's going to pay for our tax cuts. And I mean, the stock market rallying to this extent tells you that literally there's not a soul on earth who believed that story. Like literally not one person believes that. All right, so here's the question. Is this a bull trap?
No.
So now we're 4% from the all-time high. Like, is this the rally that sucks everybody back in right before we resume the downward trend? What do you think?
Well, I almost reject that premise because I don't think the people that sold bought back. It happened too quickly. But if they did, and I don't think they did because it was just a blistering speed, no, I don't think it's a bull trap. I do believe that those were the lows. But I don't believe it like with everything I got. You know, if you told me that the economy weakens and we go into a recession later in the year and we take out the lows, I would not be surprised. But
you don't think people who sold stocks in February, March, April bought anything at all?
I didn't say that. You said that.
So what do you? So the hedge funds did not buy back in, or maybe that's what the last 5 days have been.
I'm just saying, if you panicked in early April, I don't believe the market gave you a chance to buy back in. It usually doesn't.
If you panic sold, you never really got the all clear until Saturday.
Well, dude, listen to me.
The thing that made you panic is not going to be a thing anymore.
The lows were on April 8th. At that level, we were down 19 and change from the highs. Yeah. And then you had the up 10% day where we were going to do the pause. And then I think like we gave like a little bit back, and then we haven't looked back. So if you look at every single day, every single candlestick from somebody that might have sold in April, when was a great time to get back in for you? Because like the fears were still there.
That's
right?
my point. I agree. Yeah.
You probably didn't believe the rally because why would you? When all the headlines are saying we're going to retest the lows, why would you believe the rally? So I think that had you panicked, you're probably still on the sidelines waiting for a better opportunity. And what do you do now? I have no idea.
I agree, because if you were panicked, the reason you were panicked was because you thought the tariffs would cause a recession. Especially the tariff, which the people didn't care about the Canada thing or the Mexico thing. It's the China thing is the thing, right? Let's just put that out there. So the announcement of the deal with Britain, which was last week, might have been the thing that got you to unpanic a little.
Come on, I don't buy that.
But if you really didn't get what you needed until this Saturday, meaning yesterday would have been your first chance to say, all right, I was worried about the China thing. Now we're going to make a big, beautiful deal.
Yeah.
I'll put that back on.
So listen, the day after we had that up 10% day, we gapped lower by like 3% the next morning. And for the next 7 days, we gave back half of that gain. Do you remember that? That 10% candle, we gave back half of it over the next 7 trading sessions. So you probably thought, well, we're rolling over. We're going to retest the lows. You didn't buy then. And then we bounced. We haven't looked back since. So I think that, like, yeah, I'm sure traders got back in. But for, like, the average person that panic sold, they're not back in. No way.
All right. Let's define. So this is what I'm going to tell you. If this is a bull trap, and my operating assumption is that it's not, I reserve the right to change my mind, of course, but like I can't see how it would be. If it is, it's the most elaborate bull trap I have literally ever seen. And the reason I don't think it is now is because of what we heard during earnings season. But we'll get to the reason in a second. I want to start by defining the term. A bull trap is a lower volume rally that occurs in the midst of a bear market that ends up being a head fake and sucks people back in. And there have been some really convincing examples where it looked like, oh, the bull market is resuming, but it was just a bull trap. And we talked about this, Michael, you and I, a couple of shows ago, the 2000 to 2002 bear market, which I probably still have PTSD from. But the S&P rallied 5% or more on 10 separate occasions. This chart comes from Chart Kid Matt. Brutal. So those blue squiggles higher amidst this grueling 51% bear market, those are instances of the S&P rallying 5% or more, and then, as you can tell, falling apart and seeing lower lows later on. And every time that happened, less and less people wanted to play along.
Sure.
Which is why you get lower highs on the way down. So that's what an example looks like of multiple bull traps inside of a bear market. Centerpoint Securities has this really great thing on bull traps, and I just want to show you a couple of their charts. I mean, these are illustrations; they're not charts. So, like, that's, if you were to take a crayon and illustrate for somebody what does a bull trap look like, that's a really great example, because it actually breaks the downtrend, and you think you're out of the woods. But this one has gone way further than this illustration, which is why it's really hard for me to believe that this is a setup that's going to trick everybody.
Dude, we made new high. We got back all the losses. Like, it's over. I'm not saying that we can't fall, but we got back all the losses.
Okay. Usually in a real bull trap, you rally back to a resistance level, usually the downtrend, and you challenge it and fail. And that didn't happen here. Usually there are big momentum divergences or volume divergences, and that's not the case here. Like the volume, even anecdotally, the things that Robinhood is saying with trading volumes, the ETF flows, like all of that stuff is confirmation, not divergence. But let me show you what it would look like if it were a bull trap. So, like, very simply put, like a market rally that's accompanied by low volume, meaning like, people are buying, but not to the same extent they were on the way up. That's a classic tell. And so when you have really high volume like what we've had, that's how you go all the way.
So, dude,
that's a potential bull reversal.
Last month, we learned that retail traders, retail investors had the highest amount of buying ever. I think they bought like $50 billion worth of stock in a week. It was off the charts. So this is the opposite of a low volume bounce.
Let's put this let's put this chart up. So this is so we talk about a negative divergence. You don't have it here.
No, it's confirming.
You see the confirmation from RSI. Relative strength is 67. MACD, which is moving average convergence divergence, up and to the right. So you're not getting that kind of classic divergence with this rally. So we've come all the way back, and you're getting the momentum. And let me show you. I made this morning. Here's an example of a negative divergence. February. So as you can see, we come out of the election. The stock market, which is in purple, just rips higher. And 14-day relative strength or 14-day RSI is ripping with it. And then as you head into January, you see where I have that red line. That's momentum falling apart as the purple line continues to rally. Yeah. That's a classic, and a lot of our technician friends pointed it out at the time. That's a classic divergence in momentum versus price. And, look what ends up eventually happening. The market literally has the stool kicked out from under it and confirms that lower momentum, not vice versa. Mm-hmm. Now, look at the way back up. The purple and the orange line are almost perfectly synced together. So you had the negative divergence already. It wasn't this month. It was 4 months ago. Am I explaining that well, Mike?
Yeah.
Okay. Last thing on this, and then we can move on the bull trap thing. Put this last chart up. The difference between a bull trap and a bullish move, you see that volume spike with the buying in the bullish move. That's what's happening now. So I don't know what's going to happen.
Yeah.
But if you say to me is this the bull trap that sucks everybody back in? Not according to the classic definition of how I learned what a bull trap is.
Yeah, I'm with you. Ryan Dietrich tweeted over 55%, and now it's over 60, but this was earlier today. Over 55% of components in the S&P 500 made a new 20-day high today, okay? New 20-day high. This is yet another clue the lows are likely in and better times are coming. It's been higher a year later, 29 out of 30 times. So I take this
16% average return.
Yeah, I take this sort of stuff seriously. When you have this overwhelming amount of buying, and we had the breadth earlier in the year, and when the collective psychology of the market goes from everybody out to everybody in, historically that is the bottom, and it's hard to imagine given all the headline noise. But yet again,
look at this roller coaster. Put this up. This is the S&P 500 performance year to date. I asked Sean and Matt to put this together. So this is the downturn starting from February. This is S&P, not NASDAQ. Close enough. 18.9%, I guess, on a closing basis.
Mental.
And then almost perfectly symmetrical. I would say in about 2/3 of the time it took to fall, you come back 17.3%. So you're not quite back to where you are in early February at the top. You were 58.44 going into today. The high was 61.44. Back at 61.44, all the strategists had price targets of 7,000, 6,800, blah, blah, blah. That's like almost a perfectly symmetrical comeback. We're not quite all the way back, but my God.
And all the strategists, all of them, and it's not their fault. I would have done the same. That's the job. All of them lowered their price targets.
We're gonna do that in a second. Put a pin in that. What's this next chart? Percentage of S&P 500 stocks above their 20-day.
Man,
that's the left pane. 50-day, 200-day moving averages. This is interesting. So the S&P is back above the 200 as of today.
It's got to be right. I mean, it's right there.
Okay, yeah. but only half the stocks are. I think the Mag 7 X Alphabet did a lot of the heavy lifting here. Just eyeball test. Look at Nvidia went fucking nuts today. Microsoft went crazy last week.
Yeah.
Meta had a decent run. Apple even. So just like Tesla had a big bounce. So I think the Mag 7 is still doing a lot of the heavy lifting. Even though you now have a lot of stocks above their 20-day, you still only have about half the market above its 200. Do you find that somewhat meaningful? Is that the next thing that has to catch up?
I mean, RSP looks great too. I don't know. I don't know that I find it super meaningful that only half are above.
All right. Here are the sector returns off the market lows. What jumps out to you here?
From the market lows.
So April 8th.
Yeah, dude, this is real shit.
Every sector and how much they're up off the low. I'll tell you what jumps out at me. But
what jumps out to me is this is literally exactly how you would draw it up. From the top to the bottom.
If you said, all right, there's going to be a huge market recovery, rank the sectors in order of what you think will happen?
More or less. How about this? The top 5 versus the bottom 5, you would draw it up like that. So the bottom 5 is healthcare, staples, UTs, energy, and real estate. The top 5 is technology, industrials, discretionary materials, and financials. You would. That's exactly how you would draw it up. Tax
fine. I got somebody here. Bill Greebles is saying Mag 7 is not doing the heavy lifting. It's underperformed the S&P QQQ year to date. Handsome, we're saying from the April 8th low, the technology sector spider is up 26.7%.
Listen, Mr. McGreer,
and the market is not, sir.
Josh is very sensitive to people disagreeing with him, so I would tread lightly.
All right. Here's the New York Stock Exchange advanced decline line. What else could you ask for?
Yeah, it's all the things.
Pretty good. So again, this is important. If this is a bull trap, it wouldn't look like this. It would maybe you'd be like somewhere in the middle of that channel,
because we already got above where the previous highs were, not the all-time highs, but before we're higher than the Liberation Day dump. All right, so
that's right.
The question is this a bull trap? It's already been answered. No.
Well, let me say one thing. This new put that back up. This New York Stock Exchange advanced decline line includes a lot of bullshit. All the closed-end funds that trade there,
bonds,
and bonds. So this is better. Here's the S&P 500 advanced decline line. And by the way, the next time somebody shows you an NYSE advanced decline line, say, no, thank you. Show me the S&P. Here it is.
Yeah.
Look. It's an all-time high.
Yeah.
So it's tough for this to be a bull. It's tough for this to be a bull trap. The
market has had a lot of bullshit thrown at it. We were talking with Neil last week or 2 weeks ago, and we said this is a bull market. You had the biggest intraday declines erased in 3 years off bad news. That's what happens in a bull market. It shrugs off bad news. You might not like it, but
here's GLD hanging in there.
Yeah.
Up 23.3% year to date, 5.4% off all-time highs, which is nothing. That's one bad day.
Yeah.
So even with the stock market melt up over the last 5 weeks,
hang it in there.
GLD is not backing off. I find that interesting, don't you?
Yeah, I do.
You would have thought money would fly out of there once we got the recertainty that we've been joking around about, but it didn't.
Yeah.
So I don't know if that's people or central banks. We had a couple of charts from friend of the show, Todd Sohn, Strategas. These are ETF flows off the lows. So this isn't price, guys. This is the amount of dollars coming into and out of. The number
this
one
is very interesting. Wow.
So interesting, right? I think Todd sent us this today or yesterday. So the number one asset gathering ETF from the low on April 8th is Treasury bill ETFs. That part not surprising. So short duration bonds is number 2.
No, this is surprising to me. To me, as Todd writes, he says category flows have suggested equity rally skepticism since the low. So to me, this is exactly what I suggested at the top of the show. People are not buying back in. The people that sold went to bills and bonds, and they still got to get back in.
What's not surprising about it to me is when you sell stocks and you're not buying more stocks, that's where you go.
Yeah.
So that's the part that's not surprising. You're saying it's surprising, or it's not surprising?
I would have thought that given the rally, money would have had to flow into these ETFs, the market ETFs, and it did. It certainly did. It's just not the leaders.
All right, here are the surprises. Put that back up. Spot crypto was the number 3 category of ETF asset gathering.
That's wild.
$5.3 billion came racing into the safety of spot crypto ETFs. Okay, that's crazy. Growth. So growth factor equity, $5 billion. So there's the money.
Yeah.
So there's the money that came in. Precious metals at $4 billion. Okay, less surprising. More bonds. European equity was actually net positive. That's actually interesting. They bought Japanese equities on a net basis too. That's interesting. Not crazy amounts, but enough that it made the chart. All right, these were the big losers. Here's what they sold. Small cap stocks couldn't get arrested. They sold $5.5 billion worth of small cap equity ETFs since the lows on April 8th. Cyclical sector ETFs, which I don't even know. Like, would that just be like S&P materials?
Materials, industrials.
Okay. They sold Chinese stocks, negative $3.7 billion. They sold the long bond, $3.3 billion. I guess that's probably mostly TLT. And then they sold the defensive sector ETF token negative money, which I suppose is somewhat surprising. But maybe that's the nature of tariffs, was that the defensive sectors are hit just as hard in a worst case scenario.
They held up really well in the sell, so maybe that's just profit taking. I don't know.
Okay. Next chart. We got one more from Todd. This is interesting. This is the same dollar went to equity and to fixed income since the April low. So the people who were buying something in equal amount, and I don't know if cash T-bills are in here as fixed income because maybe that's misleading. What do you think about this?
They are.
They are. So that's the source of that. Okay. If anyone's going to get caught in this bull trap or look stupid as a result of this bull trap, not being a bull trap, it's the chief strategists. So chart off, Sam Rowe wrote this morning, Goldman Sachs and Yardeni Research led Wall Street in slashing their year-end S&P 500 targets as the stock market tumbled. In the following weeks, RBC, SocGen, Oppenheimer, B of A, JP Morgan, BMO, Citi, CFRA, and Deutsche Bank all revised their targets lower. On Monday, yesterday, Goldman and Yardeni revised their targets again, this time up after the U.S. and China agreed to temporarily lower tariffs. Goldman sees the year ending at 6,100, up from 5,900. Yardeni sees 6,500, up from 6,000. Sam writes, we're not going to pretend like the swing in the S&P 500 itself isn't influencing these revisions. Right. This is just marking to market, right? That's all they're doing.
What are they supposed to do? They marked it down for a reason. The reason changed, and then they got to mark it up.
Well, that's not my criticism. I have no criticism. I don't think I would be any better at this. But you're in January, full speed ahead with a 7,000 target. And then the lead up to Liberation Day, the stock market crashes. Then you cut your target to lower than where the market is, right as it bottoms. Then it rallies for 5 weeks and you raise your target. You should take your target and shove it up someone's ass because nobody needs to actually read it. Is the way if we're just like, here's my year-end target is 6,500 unless there's a market crash, in which case it'll be 5,500. Oh, that's amazing.
I mean,
and then if there's a recovery, it'll be back to 6,500. So what does the target do literally? What is it about?
I don't think anybody cares about the target.
The financial media cares.
Right. Yeah, that's it.
They write an article every time they raise the target, lower the target.
Yeah, that's it.
Look, I think I think it's the hardest job on Wall Street to come up with a price target for anything, especially the whole stock market. But don't make it even worse by marking your target to market every time there's a correction. If you're a bull, be a bull and eat it. Live through it, or don't be so bullish. If there's that much uncertainty that the minute something negative happens, you have to chop your target down, it shouldn't be as high as it was in the first place. Is that like a reasonable takeaway?
Yeah, that's harsh.
So what do you do? Stop publishing targets? Can't do
I don't
that.
know. It's a stupid thing. We know it's complete clownery. All right, let's talk about Google. So you were on the air last week when there was a report where did the report come from? Was it Apple who made this report?
It was Eddie Q testifying in court about the antitrust suit and pointing out, hey, it's not like anyone's searching Google anymore anyway.
And Eddie Q is who?
The number 3 person at Apple.
So Google fell 8% on the day.
Yeah.
And I don't know when I bought the stock, but I sold the stock for a 4% loss. And I was pretty proud of myself because I think it would have been very easy to be like, yeah, it's so cheap and this is a great buying opportunity. Maybe just add. But I'm like, you know what? I'm down 4%. Why am I, who gives a shit? Just get rid of it. Right? Like, I don't need to be dying this hill. So here's what
you're lucky you were only down 4%.
What do you mean?
I'm saying you could have been down 20% really easily. You were only down 4.
So let's start with this chart from where Google's revenue comes from. And really, it's search. I mean, we know that, right? Like the cloud is growing really nicely and YouTube is a huge engine, of course, but
50% of revenue is search.
It's search. That's it. So in my opinion, it's possible that we look back and we say, oh, wow, remember when we thought that like people were going to stop using search and ChatGPT and this, chart off, please. But this is going to be an overhang probably like forever. And even though we learned last quarter, I don't know, when did they report? 3-4 weeks ago? We learned that search grew 11% last quarter. And to me, when I saw that report, I was like, okay, like, yeah, we might be afraid of ChatGPT. It's still growing really, really, really healthily. The problem is it doesn't necessarily matter that the stock is cheap. It doesn't necessarily matter that it's growing. What matters is the threat of its crown jewel is going to be under assault for God knows how long. Okay. So I want to hold on 2 charts and then I'll give the mic back to you. So Chartkin made these. Chart on, please. This is Google since ChatGPT was launched, and it's actually up 60%, which is not that much less than the Qs. The Qs were up almost 80% over the same time. So underperformance, but not dramatically. But here's the thing: the forward PE is as low as it's been,
great chart.
Basically ever. And what changes this, I don't know. Next chart. So what I had Matt do here was compare over the last 1, 3, and 5 years all of the Mag 7 names. And yeah, over the last year, it's the only one that is down. It's down 6% over the last year. Every other Mag 7 name is up. Over the last 3 years, it's the second worst performer behind Tesla. And over the last 5 years, it's the second worst performer only in front of Amazon. So yes, it's cheap. Yes, if you're a value investor and you have a long-term time horizon, you might very well be rewarded. But for me, that's not my objective with Google. I don't want the headache, and I think the headache is not going away.
Okay. So I want to tackle that 11% stat that you just threw out. You said the growth of search was 11%. Here's the thing. That's not the growth of search. That's the growth of revenues from search.
True.
That's it. Like Meta used to do that. They would just throw another ad in. Like increasing the ad load makes the product worse and makes the revenue higher today. But it costs you customers in the future as people grow fatigue. You ever try to read something at thestreet.com?
No.
Holy shit. I dare you to accidentally click a link from, like, I don't even know how you would get there, like maybe Yahoo Finance, or there's a story at thestreet.com. People that are regular users of Yahoo Finance over the last 25 years, like that's their go-to, how they just quickly find out what's going on. When they see thestreet.com, they will not click it because they know what's about to happen. Video ad, close it. Another video ad, try to close it. It pops something else. Tickers scrolling across the bottom. Tickers scrolling across the top. A pop-up, a form to fill out. By the time you get to the second paragraph, you have seen 19 ads. Do you know why they're doing that? Because the traffic is doing this for the most part, and no disrespect to anybody who's doing a column there. I know they have like talented people, but they have turned that site into a torture chamber for the reader. And now I'm sure, and I think like private equity owns it, or somebody took it off the market. Now I'm sure whoever they were doing it to impress internally, hey, look, our revenue was up. Okay, but how, like, were the views up? Were the reads up? Or the subscriptions up? Or is the usage up? No, but the revenue's up. So Google can continue to add more buttons and bells and forms and ad units and blocks of things tracking you. They could do that for the next 10 years and somehow grow revenue. But the street has already decided that revenue growth, A, has decelerated to the point where it's a point of no return, and B, is not being accompanied by increased usage of the product. And that's why it's a 15 multiple. Now, I just said all that, but what I want to say next is, if you are a value investor, you should be buying Google hand over fist.
Agreed.
Because that's what value investing is.
Yeah.
It's accepting all of the things that people have decided are negative about the stock and saying, yeah, but I'm going to invest anyway, because I think either the negatives are overstated
So
or
I do believe that.
company can fix it.
I believe the negatives are overstated. I think that the threat from ChatGPT is overstated, but I also don't think the threat is going away. And the market doesn't think the threat is going away. So if Google rolls over and it falls another 15, 20%, I will buy it back and hold it. It's just not there yet for me.
I called it PayPal on TV, and that might have been harsh. Like, PayPal still grows. PayPal still has hundreds of millions of people that use it. The problem is there's enough competition there that it's never going to be able to grow the way it used to. It's not going to get its old multiple back. And the stock sells at 11 times earnings. That's like, I think Google search is going to be a hugely profitable business
For a long time.
for a long 20 years. I don't know.
So you know what's
For a
funny,
long
Josh?
time.
I almost forgot to mention this. We've done this segment multiple times. 5 years ago, I don't remember one. Which Mag 7 stock is like the least disruptible? And I'm pretty sure I said Apple was the most disruptible.
I would have said Alphabet is the least disruptible.
But I think we both said, at least I think I said it was Google, because it was impossible to envision ChatGPT. And the market share that Google had seemed fully impenetrable. So it shook me a little bit in a good way.
I would have said, I would say, of course, you can't envision ChatGPT. Even if it comes along, you can't envision it as a private company being able to raise $100 billion. You can't envision the speed with which that app reached a critical mass of users faster than TikTok, faster than literally anything that's ever happened before. There were so many things that you could not have seen coming. And at that time, you're talking about a company that's 95% market share.
Right.
It's unheard of. That doesn't exist anywhere in the world. But they had that. So that's why they look the least disruptible. Then the next phase of that conversation is, okay, maybe somebody could come along with a better version of search, but Google's got a lot of resources. They'll reinvent themselves. They'll cannibalize their own thing, and they'll do it too.
Wrong.
And that still might be how this turns out.
Maybe. Doesn't look well. Market doesn't like it. I'm out.
The market doesn't like it, but they are not giving up. They're working on they're working on their own bots and their own AI assistants and products that they will weave into their core products, and they'll get usage of. And I think it's not like unsurvivable. I just think it's a tougher stock than it's ever been before.
Will Google outperform the Qs over the next 3 years?
I'd say no. I'd say you would have to have a bear market for Google to outperform the rest of what's in that index. Be my guess. Because that index has gigantic companies that we almost never talk about, like ServiceNow. And these companies are probably going to be 20% growers with 40% margins. And I don't think people are going to race them with Alphabet. So I'd say probably not unless you get a bear market. All right, let's touch on inflation. We got a CPI report. April CPI rose 0.2% month over month on both headline and core, which was below expectations. The year over year was plus 2.3% on headline. Core was plus 2.8%. Those were below expectations. There's nothing really jumps out at me, like lower egg prices, stupid shit like that. Services prices ex energy were up slightly. I don't even know how important that is to the calculation. Rent wasn't crazy. Airline prices were way down. Airline fares are in the services component, fell by 2.8% month over month. That's a third consecutive negative month for airline prices, and negative 8% year over year. So that's good. Sticky part is auto insurance. But like there's nothing in there that would spook you. And I don't know. I guess the question is that the last tame inflation report we're going to get? And now we get the tariff era inflation reports?
So, yeah, I don't know. I don't know what the future inflation reports are going to hold, but this did surprise me. I'm looking at CME FedWatch tool, and a week ago, there was a 30% implied probability of a rate cut in June. And that's basically gone now. Went from 30% down to 8%. So the market seems
we're
to
at 100% chance of 2 rate cuts this year and like a 20% chance of a third.
But
for the full year, for the rest of the year.
Where do you think inflation will show up in the coming reports?
I don't think inflation is the problem. I think goods inflation is the problem, not overall inflation. And I think services deflation will be disinflationary if goods inflation is high, because high prices will kill demand and will hurt companies, and companies will lay people off. And I actually don't view the tariffs as permanently inflationary. I think
you asked me.
You wish that would be the case.
Is this the last tame inflation report? Is that what you asked me?
Yeah, because none of this stuff was in effect for April. Some of it, though, we effectively had an embargo with China. I don't know how much time you spent like reading or looking at this. I haven't spent much time at all. Okay, but from what I surmise, what spooked Trump was the retailers saying, "Expect empty shelves. If we're gonna have Christmas, we need to start getting shit in now."
I totally
and we're
agree
not
with
getting
you.
it. Okay, what we had was not a trade war. The level of tariff was so high, it effectively became an embargo. Like ships stopped coming here, or China stopped exporting here and started sending things elsewhere, and then maybe it would end up coming here.
But hang on, wait. But if the tariffs are on pause again for another 90 days, why would you think that this is going to be the last tame inflation report?
They're not on pause. They're at 30% now. We thought they would be at 145%. You see? So they bought more.
I thought on Sunday they announced that they paused them again. No,
it's 30. The level's 30. But then again, half the shit is exempt. Right? So, dude, but my point is, when I say we had an embargo, I mean like ships not moving.
Yeah. I understand.
Okay. So when I say the last of the tame inflation reports, I don't mean next month is 9% inflation again. I mean weird shit that took place during the course of May because of the gap between when the tariffs were paused and when they were fully on. Like ships stopped moving.
So I'll turn this around on you.
I'm asking. I don't know the answer.
Well, I have no idea.
What
What do you think?
I think here's the best case scenario. There are some weird readings in certain categories, and the market ignores it because the reality has changed.
I think that's likely.
So, like, you could get a really bizarre reading in one segment of the economy. Some sort of industrial material was tough to come by, or whatever, shipping rates, and then and the market yawns because they're like, all right, yeah, we know. That's because of the 145% tariffs that are no longer happening.
Dude,
so that's like a best case.
Sometimes the market is really hard to figure out. Sometimes it's easy, sometimes it's hard. Yesterday, we had Trump tweeting 80% declines in medicine prices or whatever the number was, whatever he said. And XLV was up like 4% on the day. And you're like, wait, what? And yesterday you would have said, well, the market clearly doesn't believe him. It's looking past it. Okay, that would have made sense. And then today, XLV was down 3%. Like dumped. A really bad day. The worst performer sector by far. Sometimes the market is confusing.
So one of the reasons why we keep the best stocks in the market list is to kind of check our priors. And it's like a bias elimination machine where you might not believe in something, but like price is price, and the buyers and sellers in the market they could agree with you or disagree with you, and you should at least know. And one of the things that happened last week, Sean came to me and said, yo, Carvana is the best stock in the market. And I said, no way. You have the, like I didn't say it to him, but I said to myself, he probably has the ticker wrong. No, it's like literally a best stock in the market. And the reason why I put this chart up, one of the reasons why, not the only reason why, this is the Manheim Used Vehicle Value Index. You probably heard a lot about this in 2021. This just turned upward. The Cox Automotive Manheim Used Vehicle Value Index, which tracks prices of used vehicles sold at wholesale auctions, increased, you ready, Mike? 4.9% year over year. It's important to note this was a 2.7% month over month increase, which would be a 32% annualized increase. Sean writes, automotive prices are going higher, and demand for a value-oriented service offering is in the midst of heating up. So we wrote this up for CNBC Pro yesterday. Here's a chart of Carvana.
Unbelievable.
I mean, you know what a breakout looks like.
But let me ask you this. So if the tariffs are reversed or don't go through, can't all of that demand that, like, holy shit, I better buy a car now, can't that reverse in 2 seconds?
I don't think it's holy shit, I better buy a car now. I think it's the used car being a better value than the car that can't be made or sold new because it's stuck in Mexico or the parts aren't coming in or whatever. I think that's what this is about. The other thing it's about is on May 7th, they put up an insane earnings report, 40% revenue growth. Net income was up 6x from the year prior. So they did
Carvana's one of the craziest stocks.
Dude, they did $49 million in net income in Q1 last year. That's $373 million this year. It's like just an insane story. Operating margin 9.3% versus 4% last year. Doubled their operating margin. So there's a stock at a RSI of 71. Made a 52-week high yesterday. Made another 52-week high today. I would never be bullish Carvana in the midst of a trade war. What the hell do I know? The market is saying this stock is working. This company is positioned better than I would have guessed. And it forces you to understand the story.
Yeah, no, I love it. I don't know that I've ever seen a stock go down 99%, which it did.
Me either.
It went from 370 to
Let me give you the number. It hit $3.55 in December of 2022. It hit $375 in August of 2022. 99% fall to 355, and now it's at a record high.
No, it's not 293.
A 52-week high, excuse me.
But I don't think I've ever seen a stock like this.
Now, even if you're not bullish on the used car market, Sean writes, this is one of the most fragmented markets in the country, any industry. Automotive News says 2.3% of market share is owned by the top dealership brand. 11.1% of total market share is the top 100 dealerships. That means 90% of this market has yet to have consolidated. And Carvana, probably has the financial wherewithal to consolidate as much of it as they want at this stage in the game. So, I'm not like buying the stock or going crazy, but
do you own it?
We wrote it up. It's on the list.
It's
wild.
It's a $39 billion market cap.
Yeah, I don't know what's the TAM on used cars? It's got to be enormous. And what if they decide we're not just going to sell cars, we're going to do something else? They could, like Robinhood is doing with every other vertical in financial services. What if they say we're going to take football bets? All right.
What if they get into crypto?
You want to do this recession chart really quickly, or layoff chart rather?
All right, real quick. So I thought this is notable. We're looking at, for those of you who are listening, this is from Goldman. The share of companies mentioning recession increased during Q1 earnings calls by 23%. All right, that's not a surprise. But here's what makes this very different than the two prior spikes when you had recession mentioned spike. It was not accompanied by layoffs. So the mention of layoffs only rose 2%. So it's hard to have a recession when there's no layoffs. And then not LOL, in fact, the opposite of LOL. But ironically, there was a big announcement today from Microsoft that they're going to trim its worldwide workforce by 3% which would mean almost 7,000 people are affected by the job cuts.
It's nothing. It's a better headline than it is a story. That's 6,000 people. Goldman lays off 3% of its workforce every year.
So no layoffs, no recessions. We can move on. What's next?
Okay. Coin is the last one we're going to do, and then we'll do a mystery chart and make the case. Coinbase joining the S&P 500. Let's pull up a chart. The stock's up 20-something% today. Holy shit, right? This is the first crypto component in the S&P 500. And I'm showing you guys a chart of inception back to the IPO, which of course was in 2021 or the end of 2020. It's not quite back to where it was initially when it came public, but it's come most of the way back. It's one of the most volatile stocks I've ever seen at its current market cap. But it's now replacing Discover Financial Services, which is going to be acquired by Capital One.
Yeah.
Is it poetic to you that it's replacing a TradFi giant? I mean, it's not the TradFi giant's not going out of business; it's getting acquired. But still, it's a little bit poetic, right?
Yeah, no, it is. I think they were like, it was cute. It was cute. It was cute.
Here's why that matters. This is the assets index to the S&P 500. Put this chart up, John. 1.6 trillion in ETFs, 5.3 trillion in mutual funds and insurance products. Another 3 trillion in derivative ETF, exchange traded derivatives. So it's what Bitwise has the slide saying they equate that to about $15 billion worth of demand to buy shares of Coinbase. Hence the 22% rally in the stock today. Pretty big moment.
It is a big moment. It's wild, dude. The sentiment, if you think people were worried about the stock market a couple of weeks ago, and they were, crypto Twitter was in full on panic mode. Absolute panic. And
when?
I'm not
in April?
In early April. And for good reason. And for good reason. So when the stock hit 73, there were calls for, I saw a call for 10th. Like, people were freaking out, and it is just unbelievable.
Wait, why were the crypto people panicked about tariffs? You would think that crypto is a solution to tariffs.
Just price action.
Okay.
When your assets getting killed, you get bashed. But the fact that ETH is up 50% over the last week, 63% over the past month, and Bitcoin is up, it's a wild move, really without any explanation.
Big catalyst coming up. Schwab said they're going to do digital assets sometime in the second half of the year for retail.
Morgan Stanley as well.
So that's a lot. That's two huge pools of capital, trillions of dollars.
But 53% in a fucking week. Are you kidding me?
Yeah, dude. This is
wild.
This is the market that we're in. All right. For make the case, I don't have a new stock I want to talk about. We'll talk about some stocks that we've profiled here before. Because they both just reported earnings last week, and I wasn't on the show Tuesday night, and I know people want to hear from us on this stuff. So Uber is the first one. This is a new all-time high. I'm showing you, I guess, what is this, a one-year chart? I'm showing you a one-year chart here, but you could take my word for it. Never before has it traded at 90. You can see it's been consolidating for a year, and then it broke out. I mean, the stock is on my best stocks in the market list. Obviously, it's been for a week now. 72 RSI, not too overbought.
Is this your biggest holding?
Yeah. I think it was neck and neck with NVIDIA until just now.
Good for you.
But NVIDIA went up a lot too, so I'm not 100% sure. But my top three are NVIDIA, Uber, and Apple. And
wait, Apple? I had no idea.
Yeah, I just never sold it. So it's not, I didn't buy a lot of it. I just never sold it. And it's 1000x or what, it just doesn't stop going up. Let's put up this second chart of Uber. Like, very simply put, this is the story. And I bought the stock after the IPO was my first purchase. And then I bought it in the 20s and I bought it in the 60s. So I've been buying and selling the stock, but in the last 4 years, I started to build a position and I stopped trading it. And this is the earnings versus the stock price. So what I'm showing you guys is trailing 12 months earnings. of $5.71 a share versus a share price of 90.
I love
not
charts
an
like
expensive
this.
stock.
It
Look at
matches
when the
up.
earnings.
It's not a mystery.
Yeah, it's not a mystery. It's not. Yeah, they're on a
Who are you
day-to-day
about?
basis.
Josh, who are you about to flame? You about to say shut the? Who are you talking to?
Like people equated this to a bubble when it came public because they weren't earning money. People were like, "Oh, Uber, it's not profitable. They'll never get to profitability." Really, never. That's what you want to say. Never. We just watched the price of oil go to negative $30 a barrel. You say never in the financial market. That tells me how unsophisticated you are. So this company came out of the gates losing a ton of money. They were under the cloud of a CEO scandal, the likes of which was so extreme, Brian Koppelman had to make a movie about it, right? It was like a book about the scandals at Uber. They were tracking people on the app in God mode, and they were flouting the rules in every municipality. They were operating around the world. They would operate first and ask permission later. It was just this whole thing.
Wild. Yeah, it was wild.
Then, no sooner do they emerge from that, they find Dara to be the new CEO. He has to now sell all these assets all over the world. They sell the Chinese assets because China will never let them compete with their homegrown companies. They have to take losses on all this autonomous stuff they were doing because they're burning money. So they do that. Then it's COVID. No one will ever get into an Uber again. LOL. Uber Eats ends up saving the company. True story. Then after that, it's the inflation. Oh, the inflation's too high. People aren't going to take rides. Or the drivers aren't going to want to drive for Uber because they're not getting paid enough, or whatever it is. The reopening. All right, they do that. Now it's work from home. Nobody's going to take an Uber to work anymore. Okay, they get through that. Then this Elon Musk shit starts with Cybercab. Stock gets hammered. It's like every year another crisis for Uber, and new record high today. And look at the earning. When in doubt, if you have nothing else to guide you, if the earnings line is going up and to the right, and you have a reasonable basis to think that can continue, the stock should work. So that's what I wanted to show people there. Let's do Toast really quickly. I think this is Uber for restaurants, dude. And I made the case for the stock, and I'm long, and I just bought more before the earnings. You see the post-earnings pop here was tremendous. They added 6,000 more restaurants in the last quarter. Do they have any
competitors? There's got to be one or two, right?
Clover, which is owned by Fiserv.
Okay. Yeah, I know that.
And just regular Square, but they own it. They own this business. They have 120,000 customers, and they have the Marriott. They just added the Hilton chain. They just added Applebee's. They're now doing enterprise deals with these companies that have hundreds of restaurants. It's like, just standardize on Toast. Our take rate is 50 basis points. You're going to love us. And I think it's a wrap. Put that chart back up. I'm not saying they're not going to struggle with competition, but what this looks like to me is they are now acknowledged to be the Uber of their space. Every restaurant, every bar, souvenir shops, you name it. They're just going to be standardizing on Toast, and this is going to be the platform that every employee of every hospitality business and every owner learns how to use, and they're going to become super entrenched, and they're going to be able to sell a lot of other stuff to these places, and they become I know in a recession people worry about overall gross value of restaurant spending. I think the Uber restaurants, the Toast powered restaurants will do better in recessions because those are the types of restaurants that are on their game and tracking their costs and are running professional business. And I think they'll become indispensable in a tough economic environment. I don't think people turn Toast off and say, let's go back to a pen and paper to track all the checks and everything that's happening. So that's the thesis there. Not selling it. I know it's up a lot. I'm gonna let it develop. What do you think?
I like it.
All right. I got nothing else. Let's do a mystery chart and we'll bounce out of here.
All right, John, if you'd please. All right, Josh. Well, this is a stock. It trades on the stock market. It's a newly issued stock, and it went out today at an all-time high.
Newly issued. Did it come public or was it spun off?
Public.
It had an IPO.
Oh.
It's Robinhood.
No.
Okay.
It had an IPO recently. Look at the date.
Oh, you're showing me it since inception?
Yeah.
Oh, it came public this year. The chat is saying CoreWeave.
The chat is right.
Wow. Let's put it up. Round of applause for the chat.
That is a big win. It's a big deal.
Biff got this one. Who else? R. Sterling got this one. Jerry Garcia said Reddit. Incorrect, sir. Why? What's going on with CoreWeave? So this just trades with NVIDIA, right? Is that basically how that thing acts?
I don't
More or
know.
less.
But this is a stock that came public under a lot of scrutiny from yourself included, as well as a lot of other commentators. And you love to see it. This is important. It's good. It's good stuff.
Yeah, I still don't want to own it. I respect new all-time highs. I think if I want AI, I want NVIDIA, not CoreWeave.
Okay. Well,
Both can go up.
yeah.
No disrespect. All right, guys, thank you so much for hanging with us this evening. We appreciate you. Those of you who came for the live on YouTube, you know you're the best already. People listening out in podcast land, shout to the Apple listeners, Spotify listeners, we love you too. Make sure to check out an all-new Animal Spirits tomorrow morning with Michael and Ben. We'll do Ask the Compound later this week, and an all-new edition of The Compound and Friends on Friday. Thanks so much, guys. We'll see you soon.